If you're a landlord looking at the changes in rental laws and the end of Section 21, a so-called government-backed lease with guaranteed income, no voids and no maintenance sounds like the perfect escape. It's being marketed as the ultimate set and forget property investment strategy in 2026, but it's actually very dangerous and you need to be aware of all of the risks before you start considering these. I personally get asked this about once a day within my business, Freighter Property Partners, whether we offer this strategy to our clients, and the answer is always the same. No. Today I'm revealing why I personally decide not to offer this strategy to my clients at Freighter Property Partners and all of the risks you need to be aware of before engaging in one of these opportunities. We're going to look at the valuation gap, the myth of government backing, and the cautionary tale of Lotus Sanctuary. This was a disaster that showed that this guaranteed income could evaporate overnight, leaving you with the bill. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners. We help time-poor professionals invest in properties across the Midlands, Yorkshire and the Northwest, but this channel is all about your education. So let's jump into it. The first reason why I don't offer this strategy to my clients is because the math simply doesn't work. This is known as the valuation trap. When these social housing deals are packaged, they're almost always sold at a massive premium. Because the properties come with a strong yield lease, the price is almost always inflated because of this contract. This means that you're not paying for the bricks and mortar of the property, you're paying for the contract. Most lenders won't go near these properties with a standard mortgage, which means these are often cash purchases and means the buyer is paying over the odds of the property and is immediately in negative equity. This means that you could be buying a property for £150,000 in cash that's only worth 120k, and that's because it's got this contract in place. If the lease fails, which is something we'll talk about in a few minutes, you're stuck with a property with negative equity in an area where demand is low. You're not buying a property investment here. You're buying a paper promise. And even if we set this promise to one side for a second, one of the biggest benefits of investing in property is the opportunity to leverage and build your portfolio through the value of the property, not the amount of cash you put in. With these options, because you have to buy in cash, you don't have the opportunity to leverage, which means your return on investment isn't going to be anywhere near where it could be with other properties. The second trap we'll look at is the lack of opportunity at exit. Property investment is all about two things. It's your yield and your capital appreciation. With this, you get one, but that's at the expense of the other. These properties are typically located in areas that lack growth engines. Prices often grow most because local families are buying properties and their homes in these areas. If demand is low and these people aren't buying their homes in this area, then growth is likely to be limited, especially when there's no other institutional factors. By buying here, you're trading the opportunity for 20 years worth of capital growth for a guaranteed or a so-called guaranteed income. Even if this income does increase in line with inflation, you're forfeiting the opportunity to scale the portfolio. In 2026, purchasing a property with a 10% yield in an area that's not growing in value is a lot worse than buying a property with a 5% yield that's growing in value. You build your wealth through the appreciation of the asset and the opportunity to refinance and recycle equity over time. These locations are going to be cities and areas that are being driven by home buyers as well as institutional investment. If you can buy an asset that doubles in value every few years, you're giving yourself the opportunity to really start scaling. The next myth you need to be aware of is the government-backed myth. This is ultimately a fabrication. It's not government-backed. You're going into an agreement with a private company that then has government backing. To be clear, the government doesn't sign your contract, a private company does, and they write the contracts in a way that protects their interests, not yours. You're essentially betting your entire investment on the balance sheet of this private company. If you don't work within the industry, you might not have heard of these issues. But a few years ago, a company or private organisation called Lotus Sanctuary went bust, and if you had a contract with them, these contracts essentially stopped paying overnight. This meant that landlords would purchase these properties and entered these agreements with Lotus Sanctuary, had tens of thousands, if not hundreds of thousands of pounds worth of cash tied up in properties where they're not getting this so-called guaranteed income. This meant that they had to scramble around trying to find other housing associations that could then take on their contract, which meant that they could get this income moving forward, and if not, they're stuck with an asset where they're not getting a rental income and it's not growing in value. To be completely transparent, the landlords who did this often found solutions with going to other private organisations. However, it's positioned in a way that it's meant to be hands-off. This is anything but hands-off if this situation happens to you. So if you do choose to go down this route and enter into an agreement with a private organisation, you need to make sure that you're aware of their finances, because if they go bust or enter into liquidation, your guarantee is worthless. Final problem is something I've already touched upon earlier on this video, but it's the poor return on investment. As I mentioned earlier, because you're unlikely to get a mortgage on this property, the return on investment is actually quite poor. If you buy a social housing unit for £200,000 cash and you're getting a 10% yield on it, you're making £20,000 a year. However, if you took that same 200k cash and used that as deposits for 25% down on multiple properties, you could own up to £800,000 worth of properties in high growth locations. Ignoring fees and things like that, 5% growth on 800k is £40,000 in 1 year alone, plus your rental profit. Because you often can't leverage these social housing units, you're working 4 times harder to try and build your wealth. And often because these properties are in areas with a lack of capital growth, they won't grow in much value, so you're stuck with that property giving yourself a yield. To be blunt, it's inefficient and it's a lot riskier than it sounds on the face of it. To be honest, it's difficult because I do understand some property investors want to invest in property and build their wealth and also give back to community and the wider society. And if that's you, then that's very honourable. But there's better ways to do it. You're better off buying a property on the open market and going to the local council or approaching one of these companies yourself to agree these long-term contracts. They're actually nowhere near as complex as people believe, and there's a massive demand for social housing throughout the country, so the likelihood is, as long as your property is up to scratch, that it will be pretty straightforward to get these agreements in place. And don't get me wrong, I completely understand why no void periods and no maintenance is attractive as a property investor. But your job as an investor is to protect your capital at all costs, and this isn't the best way to do that. These social housing packages are a speculative play on a private company. It is an institutional grade investment. If you want to build your wealth through property, but you don't want to give yourself a second job, don't buy a complex restrictive lease. Focus on good quality assets in areas primed for long-term growth. Rent these out to professional tenants that have been vetted by professional letting agents that are referencing to a high level, and allow your property portfolio to build your wealth without taking on significant risk. Basically, you want your property portfolio to be backed by genuine demand. That's rental demand as well as demand for local people buying local homes in that area. And if you want to build a portfolio backed by data, but you don't have the time to do it yourself or you don't have the local knowledge, then I'll put a link to our website, Freighter Property Partners, in the description, where we help time-poor professionals build property portfolios across the Midlands, Yorkshire, and the Northwest. Let's build something that's lower risk and actually works in the long term. But thanks again for watching, and I'll see you soon.